There are an increasing number of Canadians selling properties in the United States, the trend being driven in part by economic concerns, the loonie trading at multi-year lows, and the rising cost of living. But what are the tax implications to think about when selling a property south of the border? Joining us now to discuss is Nicole Ewing, Principal of the Wealth Planning Office at TD Wealth. Nicole, always great to have you on with us. Let's set the stage here. We're talking about a Canadian who owns property in the States. I guess it's important to figure out what is the status of that Canadian in the United States.
That's right. So we're only talking here about Canadian residents who are not U.S. persons, so not a U.S. citizen, not a green card holder. Some different rules might apply to them, but we're talking about Canadian citizens who own property in their personal names in the U.S. And it's important that they recognize they need to be compliant not only with the Canadian rules, but also with the U.S. rules. So there's tax implications on both sides of the border.
Let's start with those U.S. tax implications. I guess we can call these people perhaps snowbirds. It's not exactly a technical term, but perhaps for snowbirds, these U.S. tax considerations if you're selling that U.S. property.
This would include them, yes. And, firstly, the rules are a little bit different. So in the U.S., there is an act called the Foreign Investment in Real Property Tax Act. And this is an act by the IRS, essentially requiring those who are foreign owners to report when they are selling property. And there's an obligation on the purchaser, so on the buyer, to withhold some of the gross sale proceeds. And that default rate is 15%. So the purchaser is required to withhold that money. Now, there's some exceptions. You might be able to reduce that amount. So if the purchaser is going to be using that as a personal residence, if the property is below $300,000, we can reduce that withholding amount to zero. If it's between 300, and these are US dollars, so between 300 and a million, you can reduce that 15% to 10%. But we need to ensure that we are actively and proactively applying for that. So there's forms that need to be completed. There's an application that needs to be done, and you'll get that withholding certificate that then ensures that you have complied with those rules. Yeah.
So we understand that part of the equation. Also, if you're selling U.S. property, do we have to be concerned about capital gains taxes in the U.S.?
So this may catch people off guard a little bit. If you're a Canadian citizen who's not familiar with the rules in the U.S., you are selling a U.S. property, and there are U.S. capital gains rules as well, and they're a little bit different than Canadian rules. So in the U.S., there's a difference between long-term capital gains and short-term capital gains. And I think we have an example here where we can show that for an individual, a single filer, and it's important to distinguish that as well, because there's single filers, and in the U.S. you have married joint filing, married single filing. So these are the numbers for an individual filer. If your taxable income is below $48,350, you have a 0% rate. Between $48,351 and the $533,400, you'll have a 15% capital gains rate, and above that, you'll have a 20% rate. Now, so those are the long-term rates. If you have held that property for less than a year, that's regarded as the short-term capital gain, and it will be treated as regular investment income. So taxed at graduated rates potentially up to 37%, which can be quite significant. Now, there's additional state tax potentially, so those are the federal amounts, so you may have state capital gains rates as well. And for high income earners, there may be an additional tax that would need to be paid on your net investment income that only applies to those high income earners. But there's ways that you can reduce that amount. So of course, when you're selling a capital property, if you have receipts, so if you've made capital improvements to that property, that will increase your cost base, bringing that up, so your overall gain will be less. You will need to file a U.S. return with the IRS. You will require an individual tax number in the IRS. That can take some time to get as well. So there's some steps that you would need to go to. Now, if you have paid if the withholding taxes been withheld, that would come off, of course, the overall capital gains tax that you would need to pay in the U.S.
All right, so we're talking about Canadians owning property in the States, selling property. They understand now about U.S. capital gains taxes, but there's a Canadian element to this in terms of tax considerations.
There is, and so between Canada and the U.S., we have a tax treaty that generally prevents us from paying double tax. But there are some considerations we need to be aware of. So as a Canadian resident, you are required to report that same gain in Canada. Now, again, similarly with the US, we have to report our gains, which is the difference between the cost base and the proceeds on that. We need to report those numbers in Canadian currency. Now, this could be quite a significant difference if the dollar compared to the US was much lower or was much higher at the time you purchased. You're going to have some math to do to determine what your cost base is and what your proceeds are and what that gain is. And that gain needs to be reported for Canadian purposes. Now, you do have the opportunity in most situations to reduce your Canadian tax payable by the American tax that you have paid. This is your foreign tax credit. You may also have the opportunity to use the principal residence exemption. You are able to use a US property, but we need to be mindful of a few things here. If you claim the principal residence exemption for Canadian purposes, and you have already paid your US tax, you're not going to be able to get that credit for your foreign tax credit unless you have other type of income to be able to offset against. So you'll want to work with an advisor who can let you know what your tax liability is in the US, how much of that foreign tax you can get credit for in Canada, and make sure that you're not paying tax in the US and then claiming an exemption in Canada that prevents you from actually getting the full benefit of that foreign tax credit that would have been available to you. So making sure that you're aware, you can claim the principal residence exemption, but there might be reasons not to do that and to be saving that for another property that you own.
So Nicole, once you've done all of these things, there's going to be proceeds from the sale. What do we need to be aware of here?
Isn't that great? So we now have an additional source of money to look at our overall portfolio, look at the goals that we're trying to work towards. So we're looking at our investment portfolio, making sure that we're appropriately diversified and taking those proceeds and investing them in the most beneficial way. So you want to look at your overall strategy to ensure that you're maximizing the use of those funds, ensuring, of course, that you're mindful of the tax implications of that as well, but getting that professional advice about how now to take these proceeds and have them continue to grow for you here in Canada.
Nicole, as always, you do a great job of breaking down complicated issues. That said, there is a lot here. Perhaps people would want to speak with an advisor?
That's right, Greg. There are complicated issues on both sides of the border. Working with people who have experience and knowledge about the implications in Canada and the US could be quite valuable. So you may wish to consider working with somebody who has that experience and can bring that to bear on your personal situation so that you're getting the best results.
Always an enlightening conversation, Nicole. Thanks for that.
My pleasure.